Without further ado, can we please welcome to the stage Managing Director Greg DeRoos from Eastern Iron Limited.
Thanks very much, Mark, and good evening, everyone. The usual disclaimer, which I'd invite you to read at your leisure on our website. Just a quick overview of the company. Eastern Iron has three significant iron ore projects, and as the name might suggest, they're all on the east coast of Australia. And we have a strategic focus on low capex, high margin iron ore developments, which are close to bulk transport and export infrastructure in Australia, and in the future, perhaps overseas. I think it's very important for bulk commodity projects. They're very much sensitive to transport costs and capital costs. And there's a number of iron ore projects or would-be iron ore projects around this country which are waiting for capital investment or for access to port and rail. And so we can see the importance of that. Our present focus is on a high-grade magnetite hematite deposit in eastern Victoria called the Nowa Nowa deposit. Victoria is probably not a place that you would naturally think of as a place to mine iron ore, but I'm going to make that the focus of the discussion tonight because it is something that we're moving very quickly forward to, hopefully to a development point later next year. Current JORC resource for that deposit, which we announced earlier in November 2012, of about 11.5 million tonnes of just under 50% Fe in the ground, so a very high grade magnetite deposit. We've actually finished the scoping study, and that was announced, the results of that scoping study were announced in November last year, and we're currently advancing the negotiation for potential strategic partners for some of our larger scale projects in Central Queensland. Just a quick snapshot of those projects. The Nowa Nowa project is, as I said, a magnetite hematite deposit currently with a global resource of just under 12 million tonnes of just under 50% Fe. It's actually, we've improved that category at the moment. It's mainly indicated and inferred. We've got a completed scoping study which was completed in late 2012 for a mining development producing around 700,000, perhaps up to 800,000 tonnes per year of product, of iron ore product, which is very similar to a Pilbara Fines product in it's about to a little bit higher in Fe, about plus 62% Fe. And it's a fines product, which is a bit unusual for a magnetite product. It's not a concentrate. We don't have to grind it to very fine powder, as many of the Western Australian magnetite projects do. This is a coarse centre feed product. Significantly for the project, because of the very good infrastructure and the location of the project and a lot of the qualities of the ore, scoping study suggested very low capital cost of around just over $30 million. Project, as I said, located in eastern Victoria, very good project infrastructure. The deposit itself is about 2 kilometres from a sealed road and close access to the Princes Highway. We have access to roads, power in that area. The power line runs down the sealed road. The port, which we've located at which we've indicated at this stage at Eden. We're on the south side of Twofold Bay, and I'll talk about that a little bit more a little bit further on the presentation. And we've advanced the project on the basis of the outcomes of the scoping study. We've advanced the project to a definitive feasibility stage. There's also additional resource targets around that initial deposits that can provide potentially some upside in terms of the total resource. The Central Queensland projects are large, low-grade magnetite deposits, titaniferous magnetite deposits. There's two projects there that are each in the order of 500 to 1,000 million tonnes each. But the most significant feature of those projects, again, is their location, close location or proximity to existing rail, road and port infrastructure. Over the last bit over 12 months, we've made rapid progress in our assessment of the Nowa Nowa project. We picked the project up in February 2012, acquired 100% of it through an option purchase arrangement. The project had already been drilled to a large extent by the Victorian government back in the 1950s, but then had very little work done on it in the interim. And so we're able to announce very quickly a maiden JORC resource based on that early drilling of about just under 10 million tonnes. We're able to secure some core samples from the earlier drilling, or some drilling that was done in the 80s by another company, do some metallurgical test work to see the sort of product that we could produce, and that was encouraging enough for us to advance the project to a scoping study, which we announced toward the middle of last year. And as a result of some drilling that we carried out at that time, also updated really to check the early drilling that was done by the Victorian government, we announced an updated resource of 11.5 million tonnes of about 50% FE. Scoping study was completed in November of last year, and we also announced at that time that the board had approved advancing the project to a definitive feasibility study. And we also announced recently the appointment of Ingenium to complete the feasibility study. Just a quick snapshot of the company. We currently have just over 114 million shares on issue, around 2 million in cash. Our major shareholders are PlatSearch, who the company was originally spun out of back in 2008, still holding residual interest of 46% of our shares. We have another major shareholder in Adrian Critchlow, an individual investor who holds just under 20% of the shares as well. So a very tightly held stock. The chairman of the company is Steve Gemmell, who many of you will know. He's a well-known mining engineer and mining engineering consultant who sits on the board of a number of companies here in Sydney. Myself as managing director, my background, as Mark alluded to before, is a geologist, and prior to joining Eastern Iron, I spent some time with a Chinese investor here in Sydney, looking at various projects around Australia for a couple of years for possible investment and joint venture and purchase. Prior to that, I spent about 10 years with Highlands Pacific, running their exploration and also the assessment and development of the Ramu and Freda copper projects, Ramu nickel and Freda copper projects. Now, the Nowa Nowa project, as I said, located in eastern Victoria, and if I can get this pointer to work, this is the Princes Highway, which runs along the coast and from Melbourne up to Sydney up here. We've identified a potential port at Eden, which is here, which I'll talk about a little later. It's about 200 kilometres from the Nowa Nowa project here up to Eden along the Princes Highway. Significantly, there's really no towns that this highway passes through, so it's an ideal trucking route. There's Orbost about here, but the highway actually bypasses Orbost, so it's an ideal trucking route. It was used to a large extent for timber trucks to take logs up to the wood chip mill at Eden, but that business has dropped off quite significantly over the last few years and decreased in volumes on a year by year. We have about 50 square kilometres under an exploration licence. The licence is 100% owned by Eastern Iron, and we have multiple deposits in that licence area, but we focused on one particular deposit, the 5 Mile deposit, which has had all the drilling so far. We have a native title agreement in place covering the exploration phase, and the area is unoccupied Crown land, which has been very heavily logged and forested over the years, and is fairly degraded. Just zooming in a little closer to the prospect area itself, the 5 Mile deposit is the largest known of those deposits. There's several others. The 7 Mile deposit is a smaller, high-grade, high silica hematite deposit which lies at surface. Potential small open cut, we looked at this as potential DSO operation early in the project life, but the silica content is quite high, and we're still looking at how that could be reduced, but it also has potential as a weight coat or a heavy media for, or heavy aggregate for pipe coatings. The advantage of being able to develop that early in the project life is that in year one of the development at 5 Mile, because of the overburden, we have quite a lot of overburden to remove before we start production. So if we can get some production from 7 Mile, it certainly helps the economics of the total project. 6 Mile, which lies unsurprisingly in between 5 Mile and 7 Mile, is a large magnetic anomaly, but much more subdued than the others, and suggests that it's a bit deeper, and there's been no drilling done on that. This is a cross-section through the 5 Mile deposit, and as I said, there's about 30 or 40 metres of overburden. And this blue material, it's essentially volcanics. And then you've got this sub-horizontal slab of essentially just magnetite, which has to some extent been altered to hematite, and then underlain by sediments. This is averages about 70 metres thick, and up to about 90 metres on this side, thins out a bit on this side, but it's a very thick and very massive continuous body of mineralisation. So in very simple open cut, basically once the life of mine strip ratio is only about 2.3, but once you actually remove that part and the majority of that in a starter pit, the ongoing strip ratio is actually quite low. You can see the typical grades from some of the drill holes. I mean, the material itself, in terms of the iron content, is almost DSO, but some of the silica content, particularly the sulfur content, was not shown there, is a little high for DSO. So we want to beneficiate this material, do some essentially just crushing and low intensity magnetic separation, removes most of the sulfur and silica. You can see that inherently the alumina and the phosphorus values are quite low. This is a mag image just showing what I was talking about before, that you have the larger 5 Mile deposit down here. It's actually increased to about 11 million tonnes now. The smaller 7 Mile deposit, which is quite an intense anomaly, but sits at the surface, and in between this larger anomaly, which is undrilled and probably a bit deeper than 5 Mile. And that represents a target for us in the future. Just talking about the scoping study results. Essentially an open cut mining operation, mining around 1 million tonnes of ore a year, as I said, about 2.3 strip ratio over the life of mine. Processing, crushing the ore to about less than about 1.5 mil, which really dictated by the processing technique using wet, low intensity magnetic separation. You really needed about that sort of crush size to make that work effectively. But we could do it coarser, but it's much more effective at that crush size. Again, this is not a concentrate. It's not like a lot of the magnetites, or the majority of magnetite deposits that you see around Australia, which are essentially concentrate producers. They're grinding down to 30 or 40 micron. This is essentially 1600 micron, and we'll make essentially a sinter feed. So it doesn't have to be pelletized, doesn't have to be sold to a pellet producer. It would actually be sold directly to a normal blast furnace operator. Using wet low magnetic intensity is separation, which is very much low tech, off the shelf type technology, and producing around the 700,000 tonnes of high grade fines product, plus 62%. And you can see the results of the metallurgical test work that we did. Crush size 1.6 mil, mass recovery around 66, producing a 64% product, 6.8 silica, sulfur at 0.4, so it's still a little high, but iron recovery is around 75%, which is low relatively and presents us with some opportunities. Transport, again in the scoping study, trucking 220 kilometres along the Princess Highway to Eden. We just assumed standard B doubles, which are essentially 42 tonne. There is potential to increase that to 50 tonnes or maybe a bit more using B triples, and these are used in other areas in Victoria. This is a picture of the wharf loader and bulk ship loader and wharf conveyor at Southeastern Forest Exporters facility at Twofold Bay. Eden is on the other side, on the north side of that, in the distance there. So this is on the south side of Twofold Bay, but for anyone that's been to Eden. We have an MOU with the operator. That's the private wharf and loader. We have an MOU with the operators. They're very keen to do something with us because they, like everybody else in the woodchip business, are really struggling to keep that site going. Their volumes are way down on what they have been over the past few years. There's been internationally, there's a lot of dumping of woodchip products onto the market, and so these guys, coupled with the very high Australian dollar and their high operating costs they're experiencing, are struggling to keep the site going. They recently put off about 30 or 40 people, so they're very keen to do some sort of a deal with us that would help them defray some of their fixed costs of running that site. The wharf has capacity to take ships up to about 55,000 tonnes, which is around that sort of Panamax size. There's a breakdown on the capital cost. As I said, a total capital cost in the scoping study assumed at about $32 million, and that's really significant because that's what really makes this project work. A low capital cost means that that for a company, even for a company like us, if we're looking at several $100 million, that'd be a very tough ask for us to do, and we'd probably, with that life of mine, would make it very difficult to get this project off the ground. But all of those elements that exist in terms of it's not a project, it's not a remote site, so we don't have any mining camp. There's several towns within 30, 40 kilometres of the mine site, so the workforce goes home every night. The power line runs down the road 2 kilometres off the site. Again, the site is 2 kilometres from a bitumen road. We're connected by the highway to the port site. At the port, we've assumed about $5 million in capital at the port to actually create a new stockpile area and loading system. But in reality, the port operator has a stockpile and reclaimer that we're likely to be able to use. So there's probably some upside in terms of that capital cost as well. Operating costs, we purposely pushed a lot of the capital cost into operating. We've assumed contract mining, obviously, for a project like this, but we also assumed that the process plant would be contractor operated. I think at the end of the day that's probably doubtful, and so as a result we have relatively low capital cost and operating costs of around $70 per tonne FOB. So the likelihood is that will come down a bit, but the capital cost might go up a bit. We announced the commencement of advancing the project to a feasibility study late last year. We've engaged Ingenium, again, who are project delivery specialists based out of Western Australia, to complete the feasibility study and project manage the feasibility study. Process metallurgy is being provided. Advice is being provided by Resource Engineering, who are headed by a very experienced process metallurgist in Western Australia. The metallurgical test work by Amtech, it's now ALS Global. Resource studies by H&S Consultants, who most people would know. Mining studies by a group in Melbourne that some people might know of. And the environmental assessment by Earth Systems in Melbourne. In the feasibility study, we're actually in the stage of a pre-feasibility stage where we're examining certain sorts of technical issues and potential project enhancements before we actually advance the project to a final feasibility stage. And some of these technical issues or project enhancements are quite significant. One of the things I talked about before was we actually have a fairly low iron recovery at around 75%. Now this presents an opportunity because the iron that's being lost in that process is lost as hematite because it's non-magnetic, doesn't get picked up in the magnetic separation, and so reports to the tailings. And there's about 40% by weight of hematite in the tailings. So the tailings is averaging something like 40 to 45% Fe. So there's an opportunity there to increase our iron recovery simply by recovering hematite from the tailings, which is not rocket science. It's done in a number of iron ore deposits around the world, particularly in places like Brazil, and it's usually a simple matter of installing jigs and spirals. But significantly, if we can increase that iron recovery to 85%, that'll add around 100,000 tonnes of product that we've already mined, that we've already crushed, that we've essentially already paid for. So it could add significantly to the financial return on the total project. As I mentioned before, the potential to reduce transport costs, looking at slightly different transport configurations, higher capacity of trucks, and also that the potential development at 7 Mile, which might, if we can make a weight coat product from that material, potentially bring that in during year one when we're doing the initial development at 5 Mile. Also, as I mentioned before, use of existing stockpile areas and reclaimers at the SEFE port facility would reduce our capital expenditure on that project. Looking at forward into the activities over the next few months, we're targeting completion of the feasibility study by the December quarter of this year, and we're actually running the permitting process in parallel. The more natural way, I suppose, to do this would be to wait until we finish the feasibility study, examine the outcomes, and then start the permitting process. We're fairly encouraged by the outcome of the scoping study and by what we know of the project so far to really commence this permitting process early, and hopefully they'll converge toward the end of this year. Maybe the permitting process will run early into the new year, which will enable us to get to the first part of next year to the point where we can hopefully push the button on a development for the project. Just in summary, we've got a very high-grade magnetite resource, and I'm not sure there'd be too many other magnetite deposits around Australia that would be as high or higher grade. Scoping study indicates very robust economics. We can make a high-grade fines product, excellent infrastructure with access to a bulk port development, which is critical for the success of any iron ore project. Looking at a very low impact development, so we're hoping that they'll be reflected in the sort of the permitting process that we have to go through for the project in degraded Crown land. So all the elements for a potential development we feel are in place. We're already committed to a feasibility study due for completion in later this year, and looking at a very low capital cost project, which I think provides some at least protection from the sort of volatility that what the people are projecting or that we've seen in the iron ore market. Just from the point of view of that, if we get the project in place, the return on investment, the recovery of capital is actually quite quick, so we're not exposed over a long period of time. I'm fairly confident that once we're in production, and paid off and got a return on our investment, paid off our capital, that we can run this project fairly and see out the sort of dips and that people are projecting in the iron ore market. Target production in 2014. Just quickly, we have a couple of other large tonnage, low-grade magnetite deposits in Queensland. The significant part about these projects is their location. This one's 80 kilometres to the west of Gladstone, and this one's about 200 kilometres to the southwest. But all projects are accessible via existing railroads and to Gladstone. Gladstone, if we're standing here as a coal producer, you would say what makes you think you're ever going to get anything out of Gladstone, because all the coal loaders are full, and that's true. But there are actually multi-user wharfs for other products, and they have actually quite a deal of capacity. Just quickly, just summary of these projects. We currently have about just under 500,000 tonnes of resource in our JORC category for this one. We're making a concentrate around 62% Fe, and relatively high titanium in this one. The other project to the south of Gladstone is a better product, around 65, 66, and with fairly modest titanium. Our intention for both of these projects is to get a partner with deep pockets to develop the project further, because we've completed a scoping study on the projects. We're still looking at sort of $800 to $1 billion in terms of the capital cost of the project, which actually isn't too bad for a large-scale magnetite deposit, but certainly for a company our size is way out of the ballpark. So we feel that Now is a project that we can get going relatively quickly. We can get it into production, and even at with our sort of market capitalisation, we think we can probably finance it on our own and own 100% of the cash flow from that deposit. Just in terms of the value proposition for the project, and I apologise for this slide, the chart is a little out of date, although the numbers on the side are up to date, but the bars are a little out of date. But anyway, the basic message is this, that if you look at iron ore producers around Australia, whether they be very large like Fortescue, whether they be overseas like Northern Iron, and relatively small producers around 2 million tonnes, whether they have high debt, no debt, whatever, iron ore producers generally tend to have a market or an enterprise value per tonne of annual production of at least $100 per tonne. Here we are sitting down here at $6 a tonne currently. What I'm suggesting is that somewhere between now and when we get this project into production, that should increase. I'd be happy with half that. Would represent a very significant increase in the value of the company. For those who are probably not familiar with iron ore deposits in Eastern Australia, it probably covers most of us, I guess you could sort of think of this deposit in these terms. Revenue from now will be similar to an 80,000 ounce gold producer with a resource of around a million ounces, maybe a bit less, and but at a much lower capital cost, probably 25 to 30% of the capital costs that you would see for an equivalent gold producer at that scale. So we feel it's very good potential for a very high return on investment for the company and for our investors. And I'll leave it there. Thank you very much.
Round of applause for Greg.